Studies show that 70 to 90% of all traders lose money in the Forex markets. Now, in order for this to make sense, we need to strip it all back to understand the basics of Forex. Forex is short for foreign exchange. Forex traders buy and sell currency pairs to make a profit. The Forex markets are the largest financial market in the entire world, with over $6 trillion traded through it on a daily basis. This trumps the stock market at just $500 billion average daily turnover. This is more money than the combined net worth of the top 10 wealthiest people on earth. Wow.
What?
So where does this money come from? Now, it is this answer that unlocks the secret. Firstly, let's take it back to the 2nd of November, 1873. On this day, a man named Richard Wyckoff was born. From young, Richard took an interest in the financial markets and by age 15 worked as a stock runner in a New York brokerage. By his early 20s, a brokerage clerk, and by 25 headed his own brokerage firm. After spending so much time around successful traders, interviewing them and through his own analysis, Wyckoff made a revolutionary discovery. We call this the Composite Man theory.
All the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operations. Let us call him the Composite Man who, in theory, sits behind the scenes and manipulates the stocks to your disadvantage if you do not understand the game as he plays it, and to your great profit if you do understand it.
But who is the Composite Man? Well, with ChatGPT's help, I found the answer. So here we can see the Composite Man is a word designed to package the large institutions into one label. What do we mean by the large institutions? I'm talking about the central banks, large hedge funds. As you can see on the screen, us retail traders only account for 14% of the daily liquidity traded. The other 86 coming from the Composite Man. So ask yourself, who's really in control? So what does the Composite Man do?
I don't know nothing about that.
Long story short, the purpose of the Composite Man is to manipulate retail traders, which is your everyday traders, into losses, all whilst benefiting themselves. Pretty crazy, right? So how does understanding this actually help us? Well, by knowing their objectives and analysing their tactics, we can avoid being manipulated into losses and instead be on the same side as them.
Well, as they say, if you can't beat them, join them, so...
And it is through this understanding that allowed the team here at LAGFX to formulate our trading strategy. And today, I'm going to be teaching you. So before we dive straight into the strategy, there is two concepts that I need you guys to understand in order for the strategy to make sense. And the first concept that I want to teach you guys is a concept of manipulation in the markets. Now, a very typical retail way of trading. A lot of people like to follow support lines, resistance lines, trend lines, patterns in the market. And historically, over the last however many decades, that's the way that most retail traders have traded and have taught other people. And the Composite Man knows this. And as a result of that, it uses these areas in the markets as points where the Composite Man knows to manipulate, because remember what we said before, that the Composite Man is there to manipulate retail traders into losses. And I want to use a screen here in front of me just to give you an idea of how that looks. So say we go ahead and we identify a very clear level of resistance in this region. And we can see that price reacts very, very nicely in this region. And we go ahead and we also highlight a level of support as well. What I mean by us manipulating this range is you'll see that what price does quite a lot is once we have created this range where we've got support, we've got resistance, there's a lot of times that we can see that price will exit a range, give us signs of a breakout, or in this case, I like to name it a fake out, but then never actually go and follow it. And, you know, we can see that once price comes out back in, another time we see price come in, and if really kind of zoom in on what price has done in this region, we can tell by the wicks that as prices come out, it's dropped down, it's reacted, it started to make a move higher, therefore misleading the public into believing a break and retest before doing the opposite thing. What we then have here is we have price react to the resistance line, therefore giving people a reason to want to enter sell positions to sell it down to the support. We give signs of doing that before then going higher. As we then come back into the range, we react, we give another fake out of a break retest, we're moving higher before then plummeting lower. Once again, we give another sign of a break, retest, move higher before plummeting lower. We give signs of a break, retest, signs of moving lower before doing the opposite. As we then move over to this region, and this is the market live, so it does this all the time. A lot of people would see this as, let's say, a trend line, okay? And if I identify, there's two ways we could have really identified it. We could identify it like this, or we could identify it like that. You know, if we identified it like this, here's another prime example of that break retest. If we identify the line like this, where we can see prices having multiple reactions to this point. Once again, we see price break, retest, give signs of moving higher through the wicks, and then it doesn't. And ultimately, what I'm trying to explain here is that the Composite Man knows that your average retail trader is using these lines, patterns, support, and resistance as areas that liquidity lies. And what I mean by liquidity is an area where a lot of people have their stop losses or have their positions open. What do I mean by this? Well, the Composite Man knows that if there's a very clear trading range, and trading range might not make sense, I would check out the videos on the channel about Wyckoff and accumulations and distributions to understand trading ranges and understand how the Composite Man tactically creates these ranges as areas to manipulate people. But as he knows that he's created support lines and resistance lines, he knows that a lot of people will be looking to sell from the resistance and buy from the support. So quite commonly what the Composite Man will do, evident by this move, is create moves to blow people's stop losses. Why? Because once this level of resistance is created, this acts as an area of liquidity where he knows if he pushes price through or manipulates this region, he is causing people to lose money. And this is the concept of manipulation. This is something you'll see all across the markets. This is something where we see a lot of people really struggle to profit because they find that price is always giving them the delivery or the signs that a trade is valid, but then it never ends up playing out. Why? Because the Composite Man knows you're looking for that and is therefore doing anything that he can to manipulate into a loss. What I actually call this is the weak to strong hand transfer. This is a phrase that you'll hear quite commonly. And the idea is that anytime we enter a region of consolidation, we are undergoing what's called a weak to strong hand transfer. Consolidation areas is the Composite Man's prime time to manipulate people into losses. This is very evident by an accumulation and a distribution. You'll notice that anytime the market reverses, it quite commonly goes through an accumulation or a distribution, which is what we call a weak to strong hand transfer, which is where the market will enter a consolidating range. And within this consolidating range, like it has here, we have many manipulations of the range. We give a lot of different signals and make it very confusing as to what price wants to do before then creating a new trend. But that is the surface level of how the Composite Man manipulates people into losses. The second concept that we need to understand is supply and demand in the market. So the reason why the markets are able to work, the reason why there's fluctuations in the market, the reason why we're able to make profit from the market moving is because of how volatile the Forex markets are. And the reason that the Forex markets are so volatile is because we're constantly undergoing a battle between the supply and demand balance. Now, the best way to actually visualize what this means, I always reference it back to the old school weighing scales. Why I like to reference it like this is because if we see one side as supply and the other side as demand, we can understand that the more supply that there is in the market, and supply references how much selling power there is, or an easier way to view it is at any given time, how many lots are on the sell side of the market. When we look at demand, and demand is a reference to how much buying power there is in the market, or an easier way to view it is how many lots of buy positions there is. When demand is greater than supply, we'll see the market move up. When supply is greater than demand, we see the market move down. We can actually use candlesticks to understand and analyze what the supply and demand balance is at any given time. What I mean by that is when we look at very long, full-bodied candles, for example, the one we see here on the screen right now, this is a very high volume bearish candle, meaning for the duration of this candle, supply heavily outweighed demand. As we enter consolidation periods, for example, in the market, this is where there is a battle between the supply and demand balance. There's no clear trend, and price could go either one of two ways. It's during these supply and demand balance battles that we see the manipulation occur. As a result of that, I highly advise people to avoid trading during those consolidation regions because we don't yet know whether supply or demand is going to win that battle, and therefore we don't yet fully know which side of the market the trend will form. If we view different periods of the market, for example, if we move to the left ever so slightly, we can see that throughout pretty much the last month or two, we've had a trending market. We've had a clear bullish trending market, which means one thing. It means during this region, demand outweighed supply. And as a result of that, because we can see there's a clear trend in the market, that's when we want to get involved in positions because we know there's a clear bias. But in order for the Composite Man to actually control the markets, the Composite Man takes advantage of supply and demand. And if I bring that back to the idea of manipulation and understanding that every consolidation period is an opportunity for the Composite Man to reconfigure the supply and demand balance, but also manipulate retail traders into losses. Now, as a result of that, these areas typically act as what we call unmitigated orders. And what I mean by that is, in order for the Composite Man, and if we just take this region here on the screen as an example, what we've had here is we've had a very clear move up or impulsive wave higher, where demand has greatly been higher than supply. But we have then entered a bit of a consolidation region, where we've moved a bit sideways and we're a little bit unsure about what price wants to do. We can see a very similar thing just above, where price has then made a move higher and entered another consolidation period. In order for the market to come to a sudden stop and enter this region of manipulation, we know that the Composite Man is executing lots of different positions on both the buy and sell sides in order to make these manipulations happen. What do I mean by that? Well, if we go back to this range we're using as an example, we can see that price is always doing fake outs on either side. And in order for that to happen, the Composite Man is having to execute positions to make that happen. So what do I mean by that? Well, sometimes in these periods of consolidation, the Composite Man will have executed sell positions to manipulate people, but once price has taken off, the Composite Man can't always exit those sell positions in time before price takes off. And as a result of that, there is what we call unmitigated orders left in those regions that price wants to come back to mitigate. What do I mean by that? Well, if I take this region, and I'll explain what I mean by this shortly, we can see that as of where price is right now, we've come to tap into that region. And the second we've tapped into that region, we've resumed with the bullish trend. And it is by understanding these unmitigated orders that allows us to identify areas or points of interest in the market that we know there's a high probability and a high chance of price tapping into and reversing from, to give us great positions in the market to enter from. Because we know that typically, I can't guarantee every time, but very typically, when price taps into these zones, we're ready to create the next impulse higher. And arguably, the best time to get involved in a trade is the start of a new impulsive trend. So now coming back to why is this an unmitigated order? Well, like I said, because we've created a consolidation range, we know the Composite Man has been very active in the market. All that we need to know for now is if we take the sell to buy area, so we see that this is where the sell before the buy that caused the new impulse happened, okay? So the sell before the buy of the new impulse represents what we call a demand zone. So in a bullish trending market, if we find the sell to buy, this is going to reference as a demand zone. Why is it a demand zone? Because when price taps into it and approaches it, it introduces demand into the market, which typically causes the next impulsive wave of the bullishness to happen. If we were to reverse the market into a bearish trend, rather than looking for a sell before the buy of the new impulse, we'd be looking for a buy before the sell of the new impulse that price is going to tap back into, because we'd identify this as a range. It would act as what's called a supply zone, because it's a zone that introduces supply into the market. before we see price take the next leg lower. And by taking these concepts, what we've done here at LAGFX is we've created a very simple yet efficient system that allows us to be extremely profitable with our trades. We call this system the three-step approach. The three-step approach is a simple guide for how you should go about both analyzing the market and executing trades to make sure not only are you doing it correctly and following a system, and following a system is great because a system allows us to remove emotion by simplifying the process, but this three-step approach allows us to trade the market the same way as the Composite Man, so that we're not being manipulated by him, but instead being along the ride for the movements that he makes to profit alongside him. Because like we said before,
well, as they say, if you can't beat them, join them. So
I'm going to have these up on the screen, but step one of the three-step approach is market structure, aka creating a story and bias in the market. And we will always do this through what's called a top-down analysis. A top-down analysis is where we analyze the market starting on the highest time frames and slowly breaking that down to lower timeframes as we go to understand what price is doing long term, because the long term buyer, so essentially what we think price is doing long term, is going to massively dictate the shorter term as well. So if we start here on a 3-month, which is how I like to start my top downs, we can see that we are undergoing clear bullish structure. Why? We're breaking the highs and protecting the lows. If we then identify the most recent impulse within this structure, and I like to use a blue box to do this. I like to use boxes to make this easier. We then look inside of this and we look, what was the last sell before the buy started? Well, that would be this region down here. And we'll identify this one in red. We also at the time, just so you guys are aware, would have identified this region in here as well, because this is another region where we've had a sell before a big buy. And therefore I would have identified this. We can see at the time, price did react to this zone and tried to make the next move higher, but clearly the Composite Man wasn't ready for the next impulse. As a result, we traded lower and we tapped into the lower unmitigated point of interest, aka, as we now know, a demand zone. So as a result of that, currently the story that I'm creating, and remember the reason why we do a top-down analysis is to create a story, so we'll bullet point this. The story starts at this. On the 3-month time frame, we're in bullish structure. Price has just tapped a demand zone, so we're going to assume that it is ready to create the next impulsive wave higher. Given that bullish structure breaks highs and protects lows, we can assume the bullishness wants to eventually trade us to hit and penetrate this high to continue bullishness. As we then break down to the lower time frame, so for example, we come down to the weekly, we can see that what's happened since that zone tap is we've seen a very clear break of structure on the lower time frames. What do I mean by that? Well, looking at this move lower here, there was a bearish move that made this happen. The second that we broke this high, there was a break of bearish structure and creation of bullishness. What we've then seen is a very clear bit of institutional control, or the Composite Man being active. Why? Because we have created that consolidation range. And funnily enough, what have we done? Well, we've manipulated the consolidation range. What do I mean by that? We've had a fake out, a fake out, a fake out, a fake tap and reversal back down, all areas within which we would have manipulated retail traders into losses, because the Composite Man is trying to do that, before then ultimately having the continuation of bullishness. And again, once we actually saw the creation, and this is what's called a spring within an overall reaccumulation, which again might not make sense now, but as you delve deeper into Wyckoff's theories and Wyckoff's schematics, as they're called, this will make more sense. For now, just understand that we've undergone the reaccumulation, we've broken out of that range, broken structure to the top side, and we can clearly see signs that we're ready to make the next move higher in terms of bullishness. To simplify that, we've had impulse, correction, and we're starting the next impulse. If we now break that down further and we look into the day time frame, we can again see how on the daily time frame, the most recent impulse of this new bullishness that we're going to assume is to continue. If we identify, this is it's a very wiki candle, but this is the sell before the buy, which acts as our demand zone. As price has tapped into our demand zone, we've had a reaction and a reversal, and price has then continued higher. Just so you guys are aware, I actually made the prediction of this happening on the most recent Sunday sessions video we put out onto the channel, which is a weekly series where we cover our analysis for the week. And it's a trade that here at the LAGFX team, we actually took ourselves from this analysis. Be patient during this period to kind of wait out that area of consolidation. And now what I need to see is I need to see price pull back and react to these demand zones. Because if they react to these demand zones, it gives me confirmation that demand is in control. What I'm going to be just watching over the coming days as price opens is just how we react to this zone. So how is structure holding in this demand zone? So again, I already know that after price is tapped into this demand zone, demand's been introduced. And I'm going to assume, again, if we use those boxes that I used before, if this is the current impulse we're working in, on this time frame, and again, adding to the story that we've got, as we've come down to the weekly time frame, we've already undergone the first impulse and correction of the bullishness. We're currently within the next impulse, so we have signs that bullishness is happening because we've just broken the high. As we come to the daily time frame, we can see that within the most recent impulse on the daily time frame, we've just again had a demand zone tap and a reversal, and we've seen price come to break structure to show signs that we're ready to make moves higher. As a result of that, how would I look to trade the market from now? There's two ways. I'm going to identify the last sell to buy as a demand zone, and we'll put that in red. And here in the second one, there's another sell before a buy. These are the two zones that we'd react from. And this is actually the second part of the three-step approach, which we've already been doing, but that is what we call points of interest. Number two is points of interest. Points of interest is within the structure and the story that we're creating for ourselves. We identify supply or demand zones, whether we're bearish or bullish, that we know price is likely to reverse from so that we can find our entries in there. That perfectly takes us to step 3, which is what we call entry confirmation, which is where we'll use a time frame 15 to 30 times lower than the time frame we're looking at structure on. So currently we're on the 4 hour. So if we go 15 times lower than the 4 hour, we know that would be the 15 minute. As we come down to the 15 minute and we look inside of this overall zone, we can see that when price is tapped in, essentially all that we need to look for confirmation is price breaking structure to give us signs of the reversal. What do I mean by that? Well, following the structure that it's followed on this time frame, following the wick, it seems that the structural high is here. As a result, if we see price break structure, what we then want to see is bullishness start to form. We'd have a breakthrough. We then want to see price protect the low. If we see signs that price is protecting the low and getting ready for the next impulse, we execute the position here. But what's so great about doing a top-down analysis is after we've got this entry confirmation, let's say that we enter a buy position here, stop loss would either be below this structural low or this structural low. We'll just say this one for now. Because we have a higher time frame story and bias of what's going to happen, we know that on this time frame, at least we want to break this high, and therefore we'll take a partial close at this high at a 2.8 RR, or if we obviously use this structural point, we're looking at more of a 6 RR. But because we know longer term, we want price to actually come and be breaking highs much, much higher. You know, going back to the 4 hour, for 4 hour structure, we want to see this high broken, which now suddenly shoots that trade up to a 9 RR. Or again, if we use the tighter stop loss in here, which I can't really see, but you know, we're talking more 20 RR. But then going back to an even higher time frame story, let's say we wanted to hold that trade longer term. We know that on the weekly time frame, our expectation is that price eventually comes to break this high up here. And by doing this top-down analysis, that's what allows me to understand what price wants to do long-term. Not only do I know what price wants to do long-term, I'm identifying regions in the market that I know the Composite Man is going to react price from. But then once I see price react from that, I'm finding valid entry confirmation to prove that an entry is valid in the market. Because just so you guys are aware, not every single supply or demand zone you identify and look at will always hold. You know, if we go back down again to the 15-minute time frame, we just reset the chart here. It's also very possible at this moment in the market that price doesn't react from this zone, comes lower and reacts from this one. You know, there's every chance in the world that that happens. That's why we've got to wait for that entry confirmation. If you don't have that third step, if you don't wait, if you're not patient enough to know, cool, we actually need to see price break structure first, protect the low and start putting in bullishness, we don't know for sure that there's been a reversal. And by pairing the three of these together to create our three-step approach, not only are we understanding the long-term story of the market, which allows us to run much bigger trades, it allows us to enter the market in regions that we know the Composite Man is getting active, but then it gives us a foolproof entry confirmation way to ensure that our win rate is refined by not being greedy and preemptively placing trades based on our emotions, but by having a set checklist of what we need to see to enter to again remove any emotion from trading. The three-step approach is something that we actually teach all of our clients on the Forex development program, which is a 5-level development program that we have created that takes somebody from absolute beginner, never looked at the markets, to being obviously very, very good at reading a market and placing their own positions, then also understanding how to truly build a business and make money around Forex. If you'd like more information on the Forex development program, go check out the website. There's so much info here about what it is, lots of free stuff that you guys can get just to get more information on what we do and how we're able to be profitable. But I'm very, very excited for you guys now that you understand these concepts, now that you understand the dark truths about Forex, you understand how Forex actually works. But then you're also now equipped with and armed with the three-step approach. Because what I've given you guys today is I've exposed what really happens in Forex, but then I've also given you the tools that you need in order to go and master that to ensure that you're not that person that is manipulated into losses, but are instead that 10 to 30% that are actually able to profit in the Forex market. So hopefully you guys have enjoyed. If so, leave a like, leave a comment. Any support is highly appreciated, and we will see you all in the next video.